so quickly. Janet Yellen, the US Treasury Secretary there. It was only a week ago we were sat around this table talking about SVB. And for a lot of people tuning in maybe for the first time to see about this story, they'd never heard of the bank before. Tom.
Yes.
For many people,
yes.
For many people that was the case. And here we are. It's just kind of dominoed, snowballed over the last week.
And not only that bank, but each bank, as you said earlier, John, each bank has its own and different character. And what we just heard from the former president of the Kansas City Fed there, I'm sorry, what percentage of America agrees with him? And it's way larger than what you're getting from the East Coast media.
She said Americans can feel confident. Do they feel confident right now? It's not for me to say. First Republic is down about 12.8% in the pre-market. We've got one eye on Credit Suisse, one eye on First Republic. Credit Suisse is down more than 10%, Lisa, this morning. Just about holding on to 180. 180 is the low of the session. We were in the 150s a couple of days ago, but we're rolling over again.
The American consumer, first of all, Credit Suisse is its own story, and we've been talking about that, about how this is a difficult situation. Is it just building on the negative momentum that we've seen because of a concern not among the average consumer, but among businesses and where they plant their money? And that is becoming the concern, the counterparty risk, whether it's depositors, small business depositors in the U.S., or whether it's wealthy individuals over in Europe.
There was a meeting, let's get to it here with all that's going on. And John, I'm watching the U.S. 2-year really is sort of the tip point here. I would say it's not near a crisis level right now, 4.11%.
I'd say 5 basis points on a 2-year. That feels like the market's closed compared to what we've seen over the last week. Right? That's like nothing.
The markets are open, and we will continue here right now with a star of balance of power with Joe Matthew. Anne-Marie Horton joins us with what it's great to get a show started, Anne-Marie, amid a crisis. I think that helps things out. You mentioned that there was a meeting of a balance of power in Washington of Yellen and Dimon. What can you report on the delicacies of New York meeting with Washington?
What was so interesting about this is the timing. You have the Treasury Secretary on the Hill testifying, talking about everything from SVB to the health of the banking system to the fact that inflation still is the #1 priority for the Biden administration. At that same time, Jamie Dimon must have been en route, because when she got back to her office yesterday, that's the man she was speaking to, and they were just finalizing this agreement that had started on Tuesday. So this idea to get these big banks to leave this deposit in First Republic to try to shore up some of this risk and chaos in this bank came from a call, and this was Yellen's idea. She first discussed it with regulators on Tuesday, pitched it to Dimon, and then her and Dimon started hitting the phones across Wall Street, with really Jamie Dimon taking the lead on that. And then it culminated to them just finalizing it yesterday afternoon. So 48 hours, they were able to get these 11 banks together.
Anne-Marie, some of these institutions, the large ones, have been vilified for much of the last decade. Does that introduce limits to how much they're willing to do going forward from here? And by willing to do, really we're talking about acquisitions. Even if they were able to make acquisitions, would they want to?
Well, I think they obviously want to look at all of the books of some of these banks and whether or not it makes sense for them to make acquisitions. We know since the financial crisis, not all these acquisitions for some of these major big banks made sense, and they at times regret them. What they were able to do here is, well, these big banks, let's face it, they've also benefited from the last week, right? A lot of people were pulling their money from their small regional banks and putting it into the JP Morgans and the Bank of Americas because they felt like this is the safe place to go. These are the too bigs to fail. And now they're trying to help shore up those regional banks. I think for the politics of this, it definitely looks like bankers bailing out bankers coming to the rescue of other bankers, but it was government orchestrated. Instead of it being what really this administration wants to avoid is any taxpayer money having any thread or line into this. But they have been vilified, Jonathan, and what you're going to see over the course of the next few weeks is a ton of questions. The big one is obviously going to be on regulation, and the other, of course, is going to be about the Fed and whether or not the Fed should be investigating themselves.
Right. Well, Anne Marie, that's exactly where I wanted to go. The story in the New York Times talking about the Federal Reserve blocking any mention of regulatory flaws in the statement that they put out, instead thanking regulation essentially for preventing any sort of true systemic distress. What do you make of that, given the Biden administration wanted to put that in light of some of the loosening in financial restrictions a couple of years ago?
Well, I think in the end, the Biden administration probably won that debate because on Monday, the Fed came out with their own statement saying they will have a thorough review of SVB and what happened with the supervisors. I think a big question that lawmakers are facing is this the Fed in Washington that potentially there's an issue, or this is supervisors in San Francisco. And now you are hearing a growing chorus, and Joe and I on Balance of Power have spoken to a number of lawmakers about this exactly. So you have the likes of Elizabeth Warren, who wants Powell to recuse himself from this, and then you have the likes of Senate Chair of the Banking Finance Committee, Sherrod Brown, saying, I think we could let the Fed do this themselves, and he has some optimism they will be able to do it. But there is a growing chorus that does think that this is potentially the third scandal within the Fed, starting off with the trading scandal, and then they had their own inspector general look into it. There's a number of lawmakers who say an outside investigator needs to come in and needs to look at this. It should not be in the hands of the Fed, which are the ones that were supposed to be supervising this bank.
AMH, great reporting in the last 24 hours. Fantastic insight. Thank you. And looking forward to the program a little bit later. Sound On with Bloomberg's Anne-Marie Jourdan and Joe Matthew at 5 p.m. Eastern time, I believe, on TV and on radio. So, Lisa, can the Fed regulate banks? Can it regulate itself?
That's a great question. I think they would argue, yes, of course, and they'll look at what happened here. But there has been a shift in the culture under the Vice Chair of Supervision, Quarles, before Michael Barr came in. And there's some questions about what the conversations were like. We'll have to see what is revealed in some of these discussions. But how do you shore up credibility unless you have more transparency on how they're regulating and how they're stress testing these banks?
How do you shore up confidence right now? Credit Suisse, let's get that name up on screen if we can. It's down 11%. Credit Suisse right now. We've had a break of 180 again. Tom, the low of the session so far, 179.
I would say off the enthusiasm in the first trades of the good news of what seems ages ago, I think it was 30 hours ago, John, we're down 24% from those first prints of let's get on board, this is fixed. And that's not a germane number, down 24%, but the trend is the issue here. And, you know, the word elegant is just an integrity to the trend. This is a very elegant move to the south right now. It's got some real substance.
Talk about what we've had so far, Tom. We've had the Swiss regulator, the Swiss National Bank, put out a public statement of support. You've seen Credit Suisse come out and tap liquidity lines in a monster fashion, 50 billion Swiss. They're talking about repurchasing debt. The CEO's been on the screen on this network earlier this week, trying to inspire confidence, saying we're working through these issues, we're making progress.
Sounded like a McKinsey, you know.
What else can they do, Lisa?
Beyond an acquisition, which was rejected, at least by UBS, hard to see what it would be, especially given what JP Morgan put out there, which is how do they really remedy a problem that is not fixable right now without being acquired?
Silicon Valley, First Republic, Credit Suisse, they're all in the same boat. You sell your jewels first. That's usually the way it works in most homes going under. Their jewel, we really have a mystery. We don't know the flows within Credit Suisse Wealth Management or asset management. John, you mentioned earlier, they really don't want to tell us, do they? But is this the market with information, with speculation, saying, what about those flows?
Why buy the jewels if you can just take them because that's where the flows go without having to assume the liabilities?
Compete for them, to your point, particularly in Asia. Just compete for them. Why do a transaction? Just pick them up. What
competition is there going to be left in Switzerland if Credit Suisse and UBS get together? It's like Julius Baer trying to take on the world. It's, you know, that's the challenge, right? 180 on Credit Suisse. Equity futures down 0.2%. First Republic, if you're following that one. First Republic negative in the pre-market as well.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio. From Tennis Channel, I'm Andrew Tyree. Wimbledon champion Elena Rybakina made a little more history Thursday as she became the first woman from Kazakhstan to reach the semis at the 5th major. The 10 seed closing out the Czech star Karolina Mukova on her 3rd match point to move into the Final Four. And don't forget Tennis Channel's live daily coverage hits the air at 1 p.m. Eastern. I'm Andrew Tyree.
So most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And he said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
There is a tightening in financial conditions and a rise in the cost of capital, and it's clearly causing some friction.
We expect a lot more volatility, and we expect sort of sideways moves in markets.
The moves have been so big, so violent that yes, we've taken a large amount of chips off the table.
When one is facing uncertainty in financial markets, buying treasuries is a reasonable knee-jerk response.
Until recently, the talk in markets has been the Fed's not getting any traction from these rate hikes, and we're now seeing that traction.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrell, Lisa Bramitz, and Tom Keene. You thought you'd get a big break on Friday? No, you do not. On radio and television, financial crisis continues. You see it in the price of the different banks, and we'll give you coverage on that here through this hour and through the morning. John, I look at the screen, and I guess I got to go to Zurich to discuss American banking. Credit Suisse with a brutal morning. I'm not sure what it means for U.S. banking, but it is a vote of non-confidence in Zurich.
It was a break of 180 moments ago to about 179. We're down about 11% at the moment, and we've been asking the question, what else can they do? We've had the public display of support from the regulator, the Swiss National Bank.
Right.
The bank itself has tapped the SNB for 50 billion Swiss. They've repurchased debt. They're talking about doing that. What's next from them?
Well, the analog here is really interesting. Mr. Hammers of UBS, like Mr. Diamond, really needs to go over and talk to Canton authorities in Switzerland or the Swiss National Bank. That's not going to happen. Where is a meeting like what we had in America of James Diamond and Janet Yellen?
Well, we've got to go to the other side of the Atlantic and look at First Republic this morning. Their stock is down by around about 12% in the pre-market. 11 U.S. banks, $30 billion of deposits going into that institution. Is it enough to shore up confidence? Secretary Yellen tried her best in front of the Senate Finance Committee just yesterday, trying to tell Americans their deposits are safe, Tom.
And this story moves on. We have headlines now, which we must discuss. SVB Financial files for Chapter 11 bankruptcy in New York. It has a modest liquidity of $2.2 billion. And this really speaks to the things we don't talk about on air. We're not inflammatory, Lisa, until there is a headline and there is a moment within this crisis.
Well, this isn't unexpected, right? I mean, we've all been expecting some sort of resolution or non-resolution. The real question, as we've all been talking about, is why haven't we gotten a buyer? Why is it that they had to file for bankruptcy in the biggest bank failure, I believe, since 2008? We are seeing this question around who's going to come up and swoop in to do this. I wonder if we can call this a crisis, right? We keep saying this crisis in the financial markets. Federal authorities have made a real point saying this is not a crisis. This is specific institutions. But here's a crisis era, systemic risk kind of a program to fuel, to sort of tamp down the flames. So here's the question. Is this just a series of idiosyncratic stories?
That's a script.
Or is this something that has, the markings of bigger distress that will continue?
Okay, John, it's a script, and I don't know which act we're in right now, but there's a point where, in their biggest fear, is they lose control of the theater.
This is not my opinion. This is just to state a fact. They invoked on Sunday night the systemic risk exception. By doing that, they are acknowledging that this had the seeds to lead to a much bigger issue, a crisis, if you will. It's not my opinion. That's just implied by the nature of what they did on Sunday evening. This goes beyond SVB, Tom. And they quite clearly had the same fear.
I strongly agree with
Sunday afternoon.
Yeah, and it goes beyond SVB, and you wonder of the stories of the narratives of the moment, whether it's First Republic Bank or Credit Suisse and ones we don't even know, where do they go and are they systemic? I mean, there's got to be a number of banks where flows have hammered them that we don't know about.
Well, I think it's changed the game from the regulatory standpoint as well. Maybe not a story for this morning, but certainly the follow-on for weeks, months, years to come. If this institution of this size needs to invoke the systemic risk exception, then do they need the same degree of regulatory scrutiny that a much larger bank would get? And Lisa, that's going to be the talk in D.C. for much, much longer than just this week. It's going to go through the rest of this year.
And we heard that from Thomas Honig, that they have to have a much higher standard with respect to liquidity and different liquidity requirements, but also they have to pay a higher premium, Tom, for getting insurance on all their deposits, not just those to $250,000, that there has to be some charge for that. It can't come free.
And we've had bank analysts. I thought Gerard Cassidy, John, was great. I mean, you made a joke about the acronyms, but the fact is, Mr. Cassidy went 1, 2, 3. I mean, that's how these guys think under crisis.
And there is a new facility at the Federal Reserve introduced on Sunday to try and calm the nerves, but clearly this week the nerves haven't calmed too much.
We have a guest here. Our team has just done a great job, guest after guest, as we just spoke with the former president of the Kansas City Fed. John and I are going to force a data check here. John, I'm going to go to the 2-year yield of 4.15%. It's in a little bit, but it's not giving me the theater that we see in some of the printings for the banks.
Do you want the theater of the 2-year over the last week? Because I can bring it to you if you like. We're unchanged on a 2-year this morning. Yesterday, up 27 basis points. Wednesday, down 36. Tuesday, up 27. Monday, down 61. When was the last time you saw a week like that, Lisa, in the bond market?
Well, in terms of implied
Nuts.
volatility, 2008, it's like arrhythmia. You look at the chart, it looks like an arrhythmic kind of, problem with your heart.
Right now, we're going to jump to it with our guest, Anastasia Amoroso. She's Chief Investment Strategist at iCapital, but with a brilliant note out in the last 24 hours of where we are. Anastasia, you take a much broader view. You've always done that with JP Morgan and others, and you're out in searching for shadows globally this morning of these traumas. What's the shadow you're most focused on?
Well, it's in the U.S. banking sector, and we were talking about whether SVB and Signature Bank are idiosyncratic issues. I don't think they're idiosyncratic issues. I think there is a broader problem. There's some very specific things that went wrong at those two banks, but if you take a step back, let's take stock of what's happening as the Fed is raising rates. First of all, depositors have other options. And if you look at the online savings rate, for example, it is much higher than what you're getting on your checking accounts or your savings accounts. So depositors are looking for other options. And as a result, as those deposits go out, the banks are having to sell their either available for sale securities or now the fears that they're going to have to sell some of their held to maturity securities. And that means a new wave of markdowns. So this is systemic, or at least it's broad-based, and this is why I think the market is having a hard time saying, yes, this is it, this is over, because what we've seen is sort of a patchwork, a piecemeal approach of regulation, and we said the depositors of these two institutions don't have to worry about their deposits, and we sort of have an implicit guarantee, but implicit may not be enough.
Next steps, Federal Reserve meets next week. If they met today and had to make that decision, what on earth would they do?
I mean, it is such a coin toss, but the more I thought about it this week, the more I think they have to pause. It is a very different story, I think, in the U.S. versus the ECB. The ECB has pre-committed to 50 basis points, and the ECB can look at all the capital ratios and liquidity ratios of their banks and say, our banking system is fine, and our rates are not at 4.75%, and Credit Suisse is truly unique and different. But you look at the U.S. and you say the banking system broadly is experiencing strain under these level of rates. And, the confidence signal of 25 basis points, I don't really think that goes that far. The biggest signal of confidence would be to say we are attuned to the issue. We want to take the time to make sure we have the right approach in place before we resume the rate hiking cycle. To me, that would be the best approach.
The economic argument that they could make, that a lot of economists are making, is that you are seeing a rapid tightening in financial conditions in the heels of this, that you're not seeing the same kind of credit that is given over to smaller businesses. Given all of your experience in the private markets world, do you see this distress starting to spread in a way that Larry Fink is describing, saying that that's the next shoe to drop?
Not yet, and certainly not broadly, but I think it will impact pockets of private markets. So, for example, the SVB, the reason why, this is such a big deal for the startup community is forget the deposits. Deposits are safe, but what about the lines of credit? What about the loans that some of these VC-backed companies were able to get that they wouldn't have gotten from some of the bigger banks? So who's going to step in and fill the void? Now, I do happen to think that people will step in. I think there's a lot of venture capital that has been raised that has to be deployed, but guess what, Lisa? It's not going to be deployed at the same valuations. And if you look at the early stage VC valuations, they sort of never went up to the levels that the late stage venture did. We'd had a huge surge in 2021. So I think the deals may still be getting done. VCs may be the providers of liquidity, but they're going to demand a pretty steep haircut and a discount on those valuations.
So base case now for many people, Anastasia, is that growth gets hit. With that in mind, what do you play for at the moment in this equity market?
Yes, so maybe I'm a bit contrarian on this standpoint. I mean, I do agree with Lisa that this is a deflationary development and that the banks will tighten lending standards and they'll pull back on lending over time. But John, if you look at the economy today, we came into the year, the consensus did, expecting 0% GDP growth. The last I checked, which was yesterday, Atlanta GDP Fed, the projection now for Q1 is 3.2% GDP growth. This is an economy, this week aside, that sees consumer confidence that has been rising, the new manufacturing orders that are picking up, and the economy is actually fine. So I think that explains the resilience that we've seen in the market. That's why we hang around this $4,000, $3,900 level, because the economy is fine. And I think the market is betting that this banking issue is going to make the Fed at least pause. So for now, I can't say we're going to see immediate new lows in the market. But at the same time, I think how this ultimately plays out is hopefully the banking issue is fixed, and then the Fed gets back to its inflation fighting mandate. And then we have this major repricing that needs to happen, back from whatever the terminal rate is at now, 4.6% back to 5.8, maybe to 6.5%. So that's a big repricing that's probably coming for the market, let's say later this year.
That's how wide the range of outcomes are right now, potentially. Anastasia, thank you. Anastasia Amoroso there of iCapital, thank you. That was what Neil Dutta was saying yesterday, Tom. You take what Anastasia said on Atlanta Fed now, the GDP nowcast, if we can call it that, 3 handle. You overlay that with inflation, or rather you take the inflation story out. You're talking about nominal GDP at 8%.
I'm going to go back to the giant Phil Correa, who at Pioneer Group, where he says it's the bright lights of inflation and it's the bright lights of nominal GDP. It doesn't save all the zombies, but there's all sorts of companies benefited by moving from 3 or 4% nominal out to 5, 6, 7% nominal.
That's the bullish argument.
That is.
That is the bullish argument, Lisa, that you have 8% nominal and a reason for the Fed to back away.
That's the bullish argument on that. The bearish argument on that same point is that the Fed has to come in much stronger later on, as Neil Dutta was saying, and as Anastasia was expecting, at a time when people aren't looking for that.
And then break more things.
I mean, that's the concern, right?
I'm with you. Yeah, I hear you. Credit Suisse down 11%, 180. First Republic. I wasn't cutting you off. I mean, it's just I'm with you.
You're not getting me off. You're humoring me.
I'm here to indulge.
Good level of gloom.
Down 13% at First Republic. I mean, it's why I set up the bull case so that Bramo could swat it away.
Yeah,
what did the Eurozone ministers say to the US? What did they say? It was a sledgehammer on a.
Oh, it's fantastic quote. Yeah, it was basically they took a sledge. Oh, from a financial stability perspective, they really killed a fly with a sledgehammer.
You killed the fly with the sledgehammer. The bearish argument.
Thanks.
There we go.
I appreciate that.
First Republic 29.73. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The UK government and education unions agreed to begin intensive talks in a bid to end a wave of teacher pay strikes. 4 unions and the Department for Education say no school strikes will be announced for 2 weeks while the discussions are happening. The move raises hope of an agreement to end industrial action in schools across England 1 day after the government reached a pay deal with nurses and ambulance workers. Turkey is nearing ratification of Finland's accession into NATO. The move brings the military alliance a step closer to welcoming its 31st member as the effects of Russia's invasion of Ukraine spread across the European security landscape. President Erdogan is meeting Finland's head of state later today. China's central bank cut the amount of cash banks must keep in reserve in an effort to stimulate the economy as it gradually recovers from pandemic restrictions. The People's Bank of China says it reduced the reserve requirement ratio for almost all banks by 0.25 percentage points, effective from March 27th. Data shows economic activity rebounded in the first 2 months of the year, although growth output and industrial output wasn't strong. I'm Lisa Mateo. This is Bloomberg.
City, in London, in Sydney, from Washington, in Tokyo. 9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
He's there, the kind of upside.
Britain's next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it your case getting ready to make this decision?
Overall, the European banking sector remains strongly capitalized and it remains very liquid. And we have not seen the kind of deposit flights that is causing problems in the US. We've seen some shift from non-interest bearing deposits to interest bearing deposits, but typically within the banking system.
That was Howard Davies, the NatWest Group chairman, on the situation worldwide in the banking industry, a man, Tom, who knows a thing or two about the financial regulatory situation worldwide.
Glad they got him on. I called him up. I sent semaphore signals across the Atlantic, Morse code, and said, Sir Howard, please come on, John, let's talk about this because he's in the heart of this. He was the first chairman of the FSA in England, the Financial Services Authority. And to his point there, with his deep, deep experience, you guys do it different, and some would say better over in England, and particularly how you guys came out of Northern Rock versus what we're witnessing right now in America.
I think what we're witnessing in America now, though, Tom, proves that there's only so much regulation can do. This right now is a confidence issue.
Yeah.
Big, big confidence issue. And just by the nature of banking, it's been somewhat entertaining, if it can be somewhat entertaining over the last week, to hear people describe the situation with SVB and then basically describe the banking model and then say, yeah, and this is the problem because they've got this duration mismatch. And I'm sitting there like,
No, and
yeah,
Sir Howard...
Isn't that just how banks work?
Yeah.
And it's like they've finally found out for the first time that this is how banks operate, Tom. Like, this is the model. This is what they do.
I think we need to parachute in someone like Sir Howard Davies here to give us some holistic perspective. Because of the urgency of time, we get to our esteemed guest, Kenneth Leon is Director of Equity Research at CFRA. He's modestly experienced, including the 2008 crisis with some real tendency. What was that like, Ken? Take us back to March 15 years ago. You're at your desk. What was it like?
News is moving so much faster than how you can react. And even this weekend, if you're in the ratings committees at Moody's and S&P, you're trying to catch up with the market. I agree with Sir Howard. Our CFRA esteemed forensic accounting stated that European banks are in stronger liquidity position than U.S. banks. So when you go back to 2008, it was a little bit more transparent because it was the largest banks and it was really the markets. We think there's a story that's missing today, and it's almost that the conversation is binary with the Fed on financial stability, and then next week, monetary policy. But the third rail is really people. This is a people story of bank supervision. I have a report note coming out later today, and we're taking a deep dive in terms of the people story, because even if you do the walk back from legislation in 2018 to more significantly regulate the top 100 banks, there's a problem of banks with total assets with this story of 10 to 100 billion. There's $2.7 trillion in those banks. And if you're a hedge fund or you're long short, you're saying there's a cockroach theory. So the markets still don't believe that the financial stability plate has been really fully stable. And we think there's a long tail going well into Congress and the report from Michael Barr at the Fed on how do people supervise banks.
The people overnight, Ken Leon, by our reporting, suggest that $30 billion will be in what essentially is a 3-month CD, 120 days to salvage First Republic Bank. Comment, please, on the efficacy of a 3-month timeline of this plug-in. What happens in 120 days?
You know, it's not a detailed term sheet, but, 25 of the $30 billion is the 6 largest banks I cover. It's a confidence factor, and it's essentially trying everything they can to make sure that you arrest any panic and you have financial stability. So I'm not sure the timeline is that critical. The banks, particularly the large banks, Jamie Dimon and others, want to make sure that we get past this problem, and then we can ask the harder questions of what happened how do we fix this, and importantly, ring fence the problem.
Can we look at one bank in particular, Silicon Valley Bank? They filed for bankruptcy, Chapter 11 bankruptcy this morning. Even after entering receivership, this is the second largest bank ever to fall under the agency's receivership, behind only Washington Mutual. We're looking at the second biggest failure in the past couple of decades. I'm curious whether this is significant for you or an expected sort of denouement of this saga.
It's an unexpected event, but again, it's a people story. It's bank examiners and Sarah Raskin yesterday, who I don't agree with a lot of her politics, but she said this was really supervision 101 to many of the issues that you had with this bank. And I think if you can put $80 billion to the IRS, you can put more funding to the Fed so that we have more people out in the field. You're not going to have 5 to 10 Fed examiners, as you do have at the largest banks, to get down to these levels. They need more resources, or you need artificial intelligence. All these are important because it's human error that has missed this observation, and unfortunately that has created the problem.
Well, this raises a larger question, Ken, which is what's next, right? I mean, if there is this sort of human error of not being able to effectively oversee some of these smaller regional banks, how many more are there?
So my point again is, even if you walk back from the 8 largest and you capture the banks that are over 100 billion to 250 billion, our review, and it comes out every 6 months from the Fed as the supervisory report, there's 99 banks that represent 2.7 trillion that need probably more supervision, so we arrest or we have the investor confidence that this kind of problem won't happen again.
Ken, if we could see flows now, to me the big mystery into the weekend is an accounting of the flows to money market funds, to the big banks. What is your guesstimate of the magnitude of those flows?
Again, to your first question, I don't think this is 2008. I do believe that we have financially strong institutions, both in the U.S. and Europe. And I do believe Credit Suisse is really a one-off at this point. And it's been really resolved to the extent that the Swiss bank is there. I don't think we have that kind of situation, Tom, of hysteria as we did when all the wheels were coming off the tracks back in 2008.
Hey, Ken, this was great. Let's talk again next week, hopefully. Ken Leon there, Director of Equity Research at CFRA. Credit Suisse breaking down session lows, down almost 12%, 178 on Credit Suisse. First Republic, that stock very much followed over the last week or so, down about 18% in the pre-market, just off session lows at the moment, at about $28 in the pre-market right now.
And the correlations here are going to really need to be watched. I can't make a correlation like on a normal day of, say, 2's10 spread or the real yield. I just don't think those dynamics work right now. I would say the equity markets give a little angst in the VIX. You know, it's not the 30 or the 29 level of a number of days ago, but I'm sorry, pushing near 25 is sort of unacceptable right now.
Futures a whole lot softer now, down 0.7%, so that's a session low too. In the next hour on Bloomberg TV, coming up on the Open, we'll catch up with Mohammed Al-Arian of Queen's College, Cambridge, Brian Levitt of Invesco, Jack Manley of JP Morgan Investment Management, Margie Patel of Allspring joining us as well. So that's your lineup, Tom, going into the next hour and through the opening bell.
I'd love to know what Margie Patel thinks. Her ability to move seamlessly from debt instruments over to use of cash equities is world-class. And with the pop we saw yesterday in the market, it's going to be fascinating to see where she's allocating.
Got to get Mohammed's view on the Federal Reserve as well for next week, Lisa. The ECB going 50.
Oh, I thought.
Does the Fed follow through and hike?
Exactly, especially given what we heard yesterday from Richard Clarida saying that the Fed's very much going to take cues from the ECB. So if they raise 50, does that mean almost an assured 25 basis point rate hike from the Fed, regardless of the differentials on both sides of the Atlantic?
Is Aaron Rodgers going to the Jets? Is that happening?
You're asking me?
No, I'm going to bring that up maybe at the top of the hour with Mohammed.
Very sophisticated of you,
yeah. I advise that.
Is it official? Has he left Green Bay? Has that happened?
I don't think so. I think they're arguing about it, but Mohammed's been involved in that.
Well, he's like the man. He's the authority on the New York
Nobody
Jets.
came out of a meeting in Cambridge. He had his damn retriever. Talk about retrievers. It's like Jeremy Lyons.
Anyone tuning in right now thinks that Mohamed El-Arian might buy the Jets.
No,
and let's not spread that rumor.
But it's like
Start
Jeremy.
that rumor. That's a good rumor.
It's like
that's a really good rumor.
It's like Jeremy
That's essentially
Irons
the
in margin
implication.
call.
I heard.
Yeah, seriously.
I didn't hear.
No.
Future's negative. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Radio and television amid a banking crisis. Lisa Abramowitz and Tom Keene, thank you for joining us on Friday. I thought maybe we'd get a little bit of a pause here on Friday to the unfolding story. We do not. There's an announcement of a bankruptcy of SVB Financial. I've looked at the statement. Lisa, importantly, of the three items within this bankruptcy, it's only the banking item, SVB Capital, SVB Securities remain whole, but nevertheless, something to be expected to see that bankruptcy.
And the sale of some of the assets, the question really is, as you've said before, the creative destruction. Why is there not destruction at a certain point if these banks are smaller and regional and not systemic? And that is going to be a perennial question as we figure out who's next and if there is real distress.
It may be distress under a new technology where institutions, including Mr. Diamond meeting with Mr. Yellen, according to Anne-Marie Horton's reporting last night. Well, the bottom line is everybody's dealing with this anew. It's not 2008 in terms of technology, and the speed of information is like the breakdown we see in First Republic shares in the last number of minutes, and Credit Suisse making new intraday lows moments ago.
Yeah, and just some more reporting from this statement. Basically, the reason for this Chapter 11 bankruptcy is to basically open a path to sell business lines other than the banking unit. So this is one reason for filing for bankruptcy to
I've been rude. I haven't even asked you of what your wheelhouse looks like. What does high yield, what does distress, what does IG look like in this crisis?
You've been seeing it really bounce around in terms of credit spreads, but right now, just the trend generally is wider credit spreads, pricing in more distress, pricing in a higher degree of potential risk of default. Is it high enough? And that's been something Matt Mish over at UBS put out a statement and said, not really. If you expect to see a recession, we're still not pricing in recessionary types of risk in the credit markets.
That's where I want to go with our guest. But first, folks, this is important. What am I watching here? You're sitting at home and you're going, okay, there's this chaos and I really don't care what CSFB is doing in Zurich. Watch the U.S. 2-year yield, and it's real simple. It's giving way as we go into the 9 o'clock hour here to get markets open on a Friday. 4.09% now in 7 basis points. That'll be front and center through the 9 o'clock hour into the opening as well. As Lisa mentioned, it's about the knock-on effects of this crisis. Tom Honig was great from the Kansas City. I thought Ken Leon just brilliant there on banking. Now let's look over to the American economy. Kathy Bunch-Johnsick is chief economist at Nationwide. Kathy, your note says it all. It is the knock-on effects of a tighter banking environment, tighter lending, maybe stress, maybe, dare I say, emotion as well. What does it do to the American labor economy?
Good morning, Tom and Lisa. Happy to be with you. Yeah, it's the tightening of bank lending standards that's really, I think, concerning here, particularly, credit that's extended to small and medium-sized firms. Large banks are in good shape, but we're seeing still ongoing stress and questions. These banks, even if they're in good shape, are going to be looking at their balance sheet and trying to either repair it or sort of be careful, caution about making new loans. Maybe really this is doing the work for the Fed.
Kathy, the heart of the matter in research notes from economists over the weekend is going to be simple. Cautious banks, cautious financial system, and how does that fold over to United States real GDP?
Well, credit is really what greases the wheel of the economy. And if you start to see a pretty large, restriction or a contraction in that, it's going to affect economic activity, and we're going to see it slow. Now, first quarter GDP growth looks to be running somewhere between 2.5–3%, so that's strong, but that's old news. We really need to see going forward. One thing that I think is going to be interesting to watch. Next week, of course, the Fed meeting and their updated GDP and inflation numbers. What's their reaction function? What do they tell us? But even beyond that, the following Monday, we usually get the Senior Loan Officer Survey report from the Fed Reserve. It's a quarterly report. Up to this point, 40% of banks were tightening credit standards. That's typically associated with a recession. So we know that's going to continue to tighten. But this most recent episode is probably not going to be reflected, right, in that data we get for April on that Monday following the Fed meeting. But it certainly already predisposes us towards recession, unfortunately.
Kathy, I want to pick up on something you said earlier, that in some ways the market is doing the work for the Federal Reserve. Does this mean, from your vantage point, you don't think the Fed needs to hike much more? In fact, they could be done if it weren't for messaging, and it would be just as restrictive, if not more so, than it was a week ago.
Yeah, I think there's there's also a risk that they overdo it, and you're tightening into unsettled, financial markets and the financial system overall. But yes, the problem is we just don't know the degree of the tightening of lending standards. We also don't know how disinflationary this is. It should be disinflationary if it constricts capital and credit and economic activity. It should do quite a bit of the work for the Fed, and they may indeed be nearly done. But I guess I would, the markets are pricing in that they will go 25 basis points. As you pointed out, the ECB went 50. So we have evidence that central banks will tighten into this uncertain period. I think it would be more prudent to pause and have a kind of a hawkish pause as opposed to a dovish tightening that the ECB did yesterday.
Hawkish pause.
So basically indicating they're going to raise rates further down the line. I wonder how dangerous that is, though, Kathy, because at one point the Fed expressed fear of having the stop-start kind of mentality that Mohamed El-Erian has warned against, that this could create even stickier inflation and create more of a problem. I mean, what's the potential risk of that, given the momentum in the economy heading into this period, given the fact that, yes, we've seen some distress at specific banks, but it isn't some widespread kind of credit crisis?
Yeah, I mean, it's certainly not 2008, having gone through that period. It's not to that degree. I mean, very, very different conditions in terms of leverage overall for the economy. Point is well taken. I mean, it's a tough spot for the Fed Reserve. Clearly, they want to show that they're still fighting inflation and that they can. And ideally, they like to say, well, we've contained this issue and we have other tools to deal with any instability, and we can still keep raising rates. That's the ideal world, but I think in reality, it can be otherwise. And let's remember that raising interest rates is what got us into this issue, right? And doesn't raising rates in money markets yields only entice people to take their deposits out of banks and go for the higher yield?
So what is as you write this weekend, as you think about this, as critically you adjust to a, end of a tumultuous first quarter, how do you at Nationwide, Kathy, set for Q4 of this year, or dare I say into first quarter of next year? What is your tone there?
Well, we have been cautious on the economic outlook. So these events, unfortunately, just reinforce our view that we're in for some type of recession. We've been calling for a moderate recession, but still, it's pretty painful. We think unemployment rate rises 2 full percentage points, and we see growth contracting about 1.5%, starting sometime in the second half of the year. So we remain cautious, and again, these conditions only sort of reinforce that view for us.
Does that get us closer to the inflation target that the Fed has, or not so much because of some of the stickier drivers of price instability?
Yeah, unfortunately, we don't really see a big deceleration in inflation. It's really because of the core services number. So we see, it's still going to take a few years to get back to 2%. We would think that the Fed could stop raising rates sometime, maybe by the middle of the year, but that they need to hold it. Now, that's very different than what the markets are saying. The markets are saying, in a sense, the Fed's going to make a mistake, go too far, and they have to cut rates in the second half of the year.
Kathy, thank you so much. Have to run here with Markets Moving. Kathleen Bostjancic is with Nationwide. Lisa, the markets are moving here. Equities drift away here. The VIX goes out almost 2 points, 24.66. Not the tension of earlier this week, but I'm sorry, the 2-year speaks volumes. It was 4.09, and all of a sudden, I'm enjoying 4.05%. I'm in a solid 10, not fear-laden, but maybe Friday anxiety basis points.
We're shrugging off what the ECB did as any kind of tell on what the Fed's going to do, basically saying, look, okay, the ECB can raise rates by 50 basis points, but they're further behind the Fed in terms of the hiking cycle, and you're looking at a Fed that's much more compromised by the issues with financial stability.
See it in oil, too. I mean, these are little tea leaves. I don't want to oversell it to you folks now with the 2-year yield rolling over. I've also got American oil was green in the screen slightly and now red, $67.64. And maybe, Lisa, the real, the real push there Brent crude 73.86 is a global price. To see a 69 handle on that, that would be something new.
Oil's been so noisy for me. It's hard for me to make a coherent story around it, although it is traveling in tandem with other assets. I take a look at gold. A lot of people pinpointing gold as sort of one of the real assets to hedge against whatever this is. And we see that with a real bounce after really not responding about 6 months ago, but up about 1.3% as well.
In the early market trading, what would we see on First Republic? We'd say it had a bid and then it didn't.
So here's the issue. $30 billion of deposits from the biggest banks trying to shore up some sense of stability in the deposit base. The share is down 18.5% in pre-market trading, so perhaps not working to shore up some of that confidence. So what's next for this bank? What's next in terms of, is it going to be a Silicon Valley kind of non-solution or dissolution, or is it going to be some sort of acquisition or just stability?
I would think in Switzerland, the goal is to get to a market close, so they're getting there. You know, they're getting there 5-6 hours daylight savings time zones away. In Zurich, in Credit Suisse has had a very difficult day, starting out above 2 Swiss francs. And we found stability at 180 and then just given away here to 1.79 Swiss francs. And I guess I can be constructive, but if I look at the technicals, I'm not constructive because of buying. The buyers have vapored. I mean, you know, they've just walked away in the last 2 hours.
Breaking through 180 Swiss franc, you just wonder what the solution could be to shore up some sort of confidence.
The age-old solution in panic and crisis is on a Friday, get to the market close. And maybe that's what we're doing in Europe. And most decidedly, perhaps that's the banking goal in the United States as well. We're going to continue here with futures negative 26, Dow futures negative 239, the VIX 24.67. Please stay with us. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Microsoft CEO says it's infusing OpenAI's technology in its Office apps. Satya Nadella spoke exclusively with Bloomberg's Emily Chang.
Today's generation of AI is all autopilot. In fact, it's a black box that we just sort of use that is dictating, in fact, how our attention is focused. Whereas going forward, the thing that's most exciting about this generation of AI is perhaps we move from autopilot to copilot.
Microsoft is already testing it with 20 companies, including 8 in the Fortune 500. North Korea launched the most powerful ballistic missile in its arsenal just before a rare summit between Japan and South Korea, with leader Kim Jong-un saying he wanted to, quote, strike fear into the enemies. Kim was on hand with his preteen daughter to watch the Thursday launch of the intercontinental ballistic missile. North Korea has fired off about a dozen missiles in a month. Chinese leader Xi Jinping will travel to Russia next week. It's his first trip to Russia since it invaded Ukraine. During the trip, Xi is expected to discuss China's recently released 12-point blueprint for ending the war in Ukraine, a document dismissed by most Western governments. Xi and Ukrainian leader Volodymyr Zelensky also plan to speak by video link soon. And Slovakia says it will send 13 Soviet-era fighter jets to Ukraine to boost its defense against Russian forces. The jets are in different states of readiness. All have been grounded since August after a maintenance agreement with Russia was terminated. The announcement comes a day after Poland said it will send 4 Soviet-era fighter jets to Ukraine. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
Looking at the exposure, for instance, to Credit Suisse, they are quite limited, and there is no concentration. There is no a single counterparty that concentrates a large part of that exposure. The liquidity position of the European banks is robust.
Mr. de Guindos of the European Central Bank, by all accord, they came out and were on script yesterday. He is the ECB vice president. Lisa, that's sort of the summary here of what Lagarde did yesterday, as she stuck to script.
She stuck to script that everything is fine. We've got two different tools. We've got monetary policy to fight inflation, which is still a problem, and we have financial stability tools to address anything that should arise.
We're going to jump into this right now and continue this discussion with Alvaro Santos Pereira, well-timed chief economist at OECD, and we're now supposed to have a dry, boring discussion about what OECD looks like forward on economic growth. Amid bank crisis, we will not do that, and we can do that because he is schooled and is taught at the University of British Columbia and Simon Fraser, which truly owns a high ground on this arcane world of econometrics. Alvaro, we have a bank crisis going on. We have different shades of bank crisis going on. Will that diminish global GDP? Do you just assume with financial fragility, things tighten up even in China, and we see a dampening to economic recovery?
Well, Tom, well, thanks very much. So first of all, I think it's important to say that we see a fragile recovery going on. Basically, we see some positive news in terms of activity and in terms of confidence all across the world, in fact, and we see some good news regarding inflation, which it's come down in terms of headline, but even though core remains a bit fixed and sticky, and service inflation is a bit sticky. So we've been thinking about exactly what is the impact. We think at this stage, the last few days, the impact has been mostly on the risk side. That is, risks have certainly increased in terms of financial stability, and the risks overall, they're more tilted to the downside. But at this stage, we think that it's very important to say that we are undertaking and undergoing a tentative or a fragile recovery that is ongoing.
I know it's inappropriate for you as an institution and you as a chief economist of OECD to second guess central banks as well, but if we're in the interest rate structure we're in now, and particularly ex-Japan, can you state at OECD that in a general statement we are restrictive in our global monetary policy?
Well, we can say that in spite of the turbulence of the past few days, our big problem still is inflation. And so we think that we need to be more data-driven, which means that central banks for sure need to see what they need to do regarding price stability, but also financial stability. And you can see that many countries have followed different approaches. I'll give an example that even before the past few days. Brazil, they had a big increase in inflation. Their central bank was very forceful. Their core and the headline inflation is coming down, so they are taking a breather now. The Bank of Canada, in the last two meetings, they decided to, well, let's look at the data first. We've done a lot, so let's see if it is enough. And so I think central bank will have to decide what to do. Right now, this important to say in terms of financial stability, this is not 2008. Important to say that banks are in much better shape than they used to be. Regulations also in many countries and monetary authorities are way more active than they used to be. So even though, yes, there are risks and there are some episodes of financial volatility that could potentially continue, we do think that right now we don't see systemic risk still on the cards.
When does it rise to that risk? When does something break from your vantage point?
Well, I think what matters that it will be exactly if we have really bad news regarding either the inflation front, and that would mean that rates would have to go higher than anticipated, or if there's an unexpected event. Right now, as I said, what we see in terms of our risks is that even though they are tilted to the downside, the economy is starting to have, it's not only the United States, it's also in Europe and China and a few other countries in which we start seeing some positive signs out there. So I think it's important to keep the eye on the ball and understand that in spite of the very short run for volatility, we still think that at this stage the economy is slowly getting back on their feet.
Alvaro, the market disagrees, and this is sort of what I found really notable over the past couple of days. We've seen a huge repricing in Fed policy going forward. We have seen a huge repricing in expectations for inflation and for growth, at least based on the markets. Right now, people are basically expecting Fed funds rates are showing basically one more hike, then done, then almost 100 basis points still of rate cuts. What are you saying? What are you seeing that is so different to that scenario that markets are currently pricing in?
Well, looking at fundamentals. And so I understand the markets, and of course, sometimes markets overreact. Sometimes, obviously, they are on the ball, but we think that we need to look at fundamentals. And for us, the fundamentals are, how is the economy looking in terms of labor market? How is the economy doing in terms of financial stability front? And also, how's the economy doing in terms of activity indicators? And what we see right now is that, yes, it's true that very likely, because of the turbulence of the past few days, it's very likely that, for example, financial institutions might become a bit more conservative in the lending procedures. It is very possible that we might have a few volatility in a few financial institutions, but at this stage, we don't see systemic risk on the table.
From Paris, with the purview of the OECD, Alvaro Santos Pereira with us, their chief economist. Lisa, we've been waiting for this. You called for this. 2-year yield is my proxy here in the United States, but all of a sudden, markets on the move.
I can't really come up with the narrative of the day, except you're not seeing any kind of confidence stick around in the banking system to the degree that people would like. And I wonder the correlation between a small bank called First Republic and the 2-year yield, the benchmark 2-year rate.
What are you doing?
The sort of irony between that.
Do you think that James Dimon and Janet Yellen are having morning coffee today? Are they on the phone, or is he down there again?
Saying what?
You know.
What, we put more deposits? Is it working? But at the same time.
What is the next step?
Right. What is the next step? I keep going back to a point that a number of people have raised, that for a bank to raise capital right now is incredibly expensive based on the income that they are earning from pre-existing loans that were underwritten during a different era. This mismatch in profitability is an existential challenge to banks that don't necessarily have that deposit base.
To the immediacy of the move now, pre-market First Republic is broken down, and now, moments ago, breaks down decisively below a 27 handle. I don't have in front of me the chart to see what is the key level of breakdown to return to the low 20s that we saw in crisis. I believe it was yesterday or the day before, but certainly if you're just joining us on radio and TV, a real deterioration there. S&P futures negative 28, Dow futures give away 0.8%, 264 points. The VIX out near 2 points as well. Another proxy here of a broader sense, as we heard from OECD, is oil. Oil was up, it's not anymore. Oil 67.42 now, down $1, 1.4%. Lisa, what do you see in the bond market as well?
Well, I'm looking at some of the yield curves in a sort of re-inversion, and so in a way across the board. I guess I'm struggling to know how to characterize this move.
The spread market, yeah, I agree.
Well, I guess I'm struggling to understand this market in any way, shape, or form. It lacks a kind of rudder, and that's sort of the volatility that we have seen ongoing, with some of the steepest volatility implied in the bond market going back to 2008.
Credit Suisse, if you want to to look across the pond with real clarity here. Finally, some form of bid on Credit Suisse. We go from a low well under 180, and we've launched out up to 1.83. There's a bit of good news. But again, to get back to First Republic Bank, and for those of you tuning up for a Friday morning, you thought it would be peaceful. It's not. 12, I can't remember the number, 13 American banks, 12 American banks, 2 American banks, a set
11.
of American banks.
11 American banks.
There
It was
we
$30
are.
billion.
$30 billion was some form of 120-day window. And the semantics of the word deposit is the headline today. I think it's going to be great to hear Mohammed El-Arian with John Farrow discuss not only the idea of what is a deposit, the semantics of this word deposit. I think now, I feel like I'm in a bad Umberto Eco book or something. Here, look, what does deposits mean?
The amazing thing to me is just by the end of today, we have no idea the path from now to then and the news flow that we've been seeing. And right now, we're going to have to see what the reaction function in central banks really is, if inflation still is, as Christine Lagarde said, the preeminent concern.
First Republic Bank under 27 is where we are this morning. We need to say here, with a few seconds left on a Friday, what an extraordinary week by Team Bloomberg Surveillance. The character of the guests. I'm sure all three of us have a different favorite guest, but
a lot of wonderful voices on a really difficult week.
To continue forward, Bob Diamond this afternoon on Bloomberg.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's Renewable Assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
This feels like we've got one more long trading session ahead of us. Live from New York City this morning. Good morning, good morning. Equity futures down 0.8%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Wall Street banks throw First Republic a lifeline. Credit Suisse and UBS are said to be opposed to a tie-up as banks suck up billions from the Fed's liquidity backstop. We begin with the big issue, little fires everywhere.
We've had a series now of problems.
3 banks having been shut in the U.S.
What we've just seen in terms of banking system in the U.S.
And now, obviously, the stress we're seeing in Switzerland.
Good bank, bad bank, whatever you want to call it.
There's a long, long road ahead for Credit Suisse.
The bond market is the place where you see the volatility express itself.
What's happened is investors are sniffing out weakness everywhere they can.
The market is in the seek and destroy mode.
The fear psychosis about being blindsided on where the next risk is going to come from.
It will be seeking those weak links.
What's happened over the past week or so?
It is absolutely remarkable that Chair Powell teased that 50 basis point hike on Tuesday, and 24 hours later, the financial stress began.
It just makes you worry about a tip of the iceberg.
Next week's meeting is a tough call.
Let's bring in the Bloomberg team. Ollie Crook in Zurich at the Credit Suisse headquarters. Sonali Basak, Michael McKee here in New York City. Sonali, first to you. First Republic right now in the pre-market, down 24%.
Call it the panic of 2023, John, because if you look at our bank rescue modeled after what was largely seen as what happened in the panic of 1907 or even long-term capital management in the late 1990s, you are seeing security last you less than a day. Again, as you said, the stock market moves are pretty drastic for First Republic. Even after market yesterday, remember, you have a lot of the market also betting on the bonds here. There's an ultimate end game question. Those are under the surface here because once you watch this deposit rescue float in just yesterday, you have questions about what happens next. What happens to depositor flight, not just at First Republic, but at other banks as well. The million-dollar question in the room is just that. The good news for First Republic here is you did see the banking industry step up to save First Republic, because if you see what happened over at Silicon Valley Bank quickly here, John, you have them 1 week after the FDIC rescue last week say now that the parent company is also filing for bankruptcy. Remember, this has been a very, very tricky sale process over the week. The question here for banks now is to make sure that other banks don't get to that point.
Mike McKee, big demands on the Federal Reserve. What else can they do?
That's a good question, because we're getting to sort of some of the limits of what they would be able to do and want to do, although our friend Gina Smiak has the book Unlimited, which suggests they can do anything. There's been a lot of questions about the balance sheet and whether they can continue to absorb things onto the balance sheet, because the $153 billion they lent out through the discount window reversed about half of what has been already taken out in QT, and the Fed at this point is having difficulty figuring out how far they can go, but it's temporary. That's the thing. It is not going to last. It's 90 days, and so it really isn't going to have a major impact on the overall cost of credit, even though we're seeing credit loosen up a little bit. It is going to go back the other way probably in a very short period of time. Then we look at what's going to happen next week, and there's a discrepancy here. Economists are pretty much convinced that the Fed is going to go 25 basis points, but you can see the market pricing there is no move. So markets at this point, or economists?
25 or 50. That used to be the conversation. Now it's 50 or nothing for the ECB, and now for the Federal Reserve, 25 or nothing. That conversation has changed really quickly. Mike McKee, Ollie Crook, Sonali Basak, thank you. First Republic down 21% in the pre-market. Credit Suisse down almost 10% in early trading. Down 10% to about 182. I want to bring in Mohammed Al-Arian. He joins us from Queen's College, Cambridge. Mohammed, a wise man once said, beware of little fires everywhere. Mohammed, those little fires, your words, are they getting bigger?
They're getting bigger because people are questioning the fire department. They're questioning whether the crisis managers are up to the task. And the story today in the New York Times about the Fed pushing back on a negative reference to bank supervision hasn't done much to the confidence. So yeah, I mean, these little fires are getting to be messier, and the need for a circuit breaker is even stronger now.
Mohammed, what circuit breaker can they provide? You wrote earlier this week about the difference between what the UK did last weekend and what the United States did over the last week. This is what one senior Eurozone official described to the Financial Times. They said the following, and this is pretty brutal, Mohammed, it's scathing in fact. They're shocked at the, quote, total and utter incompetence of US authorities. Has it been that bad?
I mean, that's pretty, I think, exaggerated. But there's a reason why they're angry. They're angry because there is an international standard, an international understanding on how you respond. And that got thrown out the window last weekend by the US. And it may be that they didn't even consult with other regulators in doing this. But John, there's a bigger issue, and we've seen this with monetary policy. When you make mistakes early on in the process, your policy options become more and more restricted. You know, the market today, in the case of Credit Suisse, and to some extent in the case of First Republic, is asking about the viability of the business models. It's basically saying that these business models are under enormous pressure. Deposits are going to be shaky. Other banks, in the case of Credit Suisse, are going to step back from interacting, just look at where the credit default swap is. And therefore, the business model itself is under pressure. And what we've discovered is that it's not easy to sell a troubled bank to another institution. The Bank of England pulled it off wonderfully last Monday, but neither with Credit Suisse is proving very difficult to find another bank interested in taking it over.
Mohammed, they used the systemic risk exception for a bank that previously we wouldn't have considered systemically important. It feels like the game has changed, Mohammed. They're also saying things like, you heard this from Secretary Yellen yesterday, that all depositors in America can be confident their deposits will be there when they need them, but the FDIC still has a limit of 250,000. Are they trying to play some kind of Jedi mind trick just to encourage people to get their confidence back so they don't pull out their deposits, even though they're not going to change that insurance limit?
Look, I don't think deposits are at risk in the United States. I think the fact that you triggered that exception and you basically guaranteed deposits with no limit in First Republic's case means that you've de facto done it for other banks. And I think what you heard from Secretary Yellen is very important. Deposits are not at risk. It's the rest of the capital structure that is at risk. And that's why both the stocks and the bonds of Credit Suisse and certainly the stocks of First Republic are under so much pressure. It's the rest of the capital structure, but not the very top of the capital structure deposits.
Even the ultimate tail risk, even if that does not materialize, the takeaway at the moment, Mohammed, seems to be the following, and this came from Michael Hartnett of BofA, that bank emergency borrowing would lead to tighter financial conditions, tighter lending standards, small business credit crunch, and ultimately higher unemployment. We've heard it from BofA, I've heard it from Morgan Stanley, from Wells Fargo, from JP Morgan, from Goldman, take your pick, that they believe, base case now, that these issues in the past week will lead to tighter lending standards and softer growth. Is that your base case too?
Yes, they're right. There's going to be two reactions why that's going to happen. One is the banks themselves. They're going to put safety first, so they will tighten their standards. And second, there is a generalized expectation now that we will have tougher regulation, that you've had an accident on the freeway and the immediate reaction is going to be to lower the speed limit. So you will get it. The expectation is you better tighten your lending standards, both for your own reasons and then because there's going to be more regulations coming your way.
Isn't this going to take care of the Fed's job for them? Just this process, this sequence of events?
Yeah, John, I laugh when people say, oh, the Fed's policies are finally gaining traction. Is this the way we want the Fed policies to gain traction? By destabilizing the banking system, by creating a credit withdrawal, by having too much damage to the real economy and to jobs? You know, that's not how monetary policy is supposed to gain traction, not through financial instability. So yeah, to some extent, it does mean that the Fed will end up with lower inflation than would have been otherwise, but the journey there is terrible and is unnecessary. I think the Fed has an immediate problem for next week, and that is that the ECB did a great job. I called it actually a masterclass on Twitter yesterday when I was listening to President Lagarde's press conference of separating price stability and financial stability and saying we have multiple tools for multiple objectives and we will not commingle them. And you saw the market's reaction to that. It was positive.
So let's talk about this then. What do you think the Fed will do based on the experience of the ECB?
I think this Fed, and now I'm going ahead of an FT column coming out on Monday. You always do this to me, John. I think this Fed will be very tempted to try and somehow be in the middle and say, we will not raise rates, but it's a pause. It's not an end to the cycle.
So you think a break? Would you call it a break? Take a break and wait?
I think that is what they will be tempted to do. I think that's the wrong thing to do. This is the wrong thing to do. You end up yet again in the muddle middle. You end up yet again flip-flopping. You end up yet again with inconsistent communication. But this Fed, I suspect, will be inclined to do this. I hope they don't, but it wouldn't surprise me if they're inclined to do this.
I wonder what you make of this psychology. Diana Randau, here at Bloomberg over in Frankfurt, she revealed, according to sources, Mohammed, that at the ECB, fears that anything but a half-point hike would trigger panic among investors. And they thought that if they didn't hike, it would send an even bigger signal. So ultimately, they settled on 50. What do you make of that?
No, it's very hard to comment on that because you don't know what the counter was going to be, right? You don't know what the counterfactual is. But I think, John, the reaction of markets says it all. When they announced 50 and when Christine Lagarde spoke at her press conference, the equity market rallied. And that says that they did the right thing. And it also suggests that had they not done that, it could have been the other way. But it's very hard to specify the counterfactual.
So let's wrap things up. In the last week, Bob Michael, JP Morgan, he said, these events, tip of the iceberg. Someone you know really well, we all really respect, Dan Iverson over at PIMCO. He said this could be a multi-month process. How would you describe this moment for markets now, Mohammed?
I think Dan Iverson is absolutely right. This is a multi-month episode, and it's not just multi-month on the financial side, it's multi-month, more importantly, on the economic side. Even if we are able to resolve these jitters in the next few days, and I really hope we can, we need a circuit breaker. Even if we're able to, the economic consequences, the political consequences, the social consequences are going to be with us for a few months. You know, John, when you started the show, you said this looks like it's going to be a long, and I thought you were going to say weekend. Think of Switzerland this weekend. They're going to have a long weekend in Switzerland.
Yeah, I said one more day of the trading week to go, and I think for a lot of people it feels like there's three, or maybe this week just never ends. Mohammed, wonderful to catch up with you. Thanks for carving out some time and teasing, the FT column on Monday. I did promise this a little bit earlier, Mohammed. I'd get your thoughts on Mr. Rogers going to the New York Jets. Is that happening?
Do I really have to comment?
You've got to comment. You've got to fit one in. Is that what you want to happen?
I have enormous respect for him. I think he's an amazing quarterback, but I'd rather we invest and be consistent with younger players than try. We've tried this before, and if it works for a year, maybe two, and then we're back to the same problem.
Is that like a Fed Band-Aid kind of thing, Mohammed? Is that what you'd suggest? Maybe.
You may very well say so. I couldn't possibly comment, John.
Mohammed, thank you. Always good to see you. Coming up on this program, the ECB setting the stage for Chair Powell.
Let me reassure you, we are determined to fight inflation and return it to 2%. And we will take the measures that are necessary.
That conversation up next with Jack Manley and Brian Levitt from New York. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence. We are not waning on our commitment to fight inflation, and we are determined to return inflation back to 2% target in the medium term. That should not be doubted. The determination is intact, and the path at which we will cover the ground, the pace that we will take, will be entirely data dependent.
The ECB staying the course and delivering that 50 basis point rate hike. Bloomberg's Jana Randau reporting the following, that fears that anything but a half-point hike would trigger panic among investors, help settle the ECB's interest rate decision on Thursday. The concern of sending the wrong signal, weighing on this ECB and setting the stage maybe for the Federal Reserve on Wednesday. Joining us now to discuss, JP Morgan's Jack Manley, alongside Invesco's Brian Levitt. Brian, first to you, can you take away something from what the ECB did to gauge what you think the Fed might do next week?
Well, the ECB has been behind the Fed with regards to tightening, so there is a little bit of catch-up that's going on there. And, all this talk of that the market would have been disrupted had they not done it. I mean, again, perhaps Mohamed Al-Arian was saying you can't prove a counterfactual. But in the U.S., we have already seen the markets get ahead of this. The two-year rate has come down rapidly. The Fed funds implied rates have come down. So we've recalibrated, the markets have recalibrated for perhaps even a 50 basis point hike to maybe 25 next week. I personally would like, after all this tightening, and we know the lagged effects of this, for the Fed to take a step back and assess. But it seems like another 25 basis points is in the offing next week.
Jack, what about you?
I think, first of all, you have to draw a distinction between the environment in Europe and the environment in the United States. To Brian's point, there is more room to run when it comes to the ECB hiking, but I think it's important to point out that there are very clear disinflationary signs here in the U.S. You can't really necessarily say the same thing over in Europe, at least not just yet, which means that investors in the States, I think, are desperate to look for some sort of signal that the Fed is almost done. There is so much fatigue here. So while a 50 basis point hike might have been necessary over in Europe from the ECB, I can't really comment on that. I would say that if the Fed decided to not go to 50 basis points or not even go 25 basis points, that would be met with, I think, some sighs of relief.
They're trying to restore confidence in the banking system. We've got First Republic in the pre-market down at more than 20%. 11 banks in America coming together to deposit $30 billion US into this institution, and yet still we're lower. They've had to suspend their dividend. That's widely expected. Brian, all these things are going on. The authorities move on Sunday evening, and I'm sitting here wondering, what else can the authorities do at this point to restore confidence? And can this Federal Reserve really sit there around the table next week and draw a fine line, a hard line, a fat line even between the financial stability issues and the monetary policy objectives?
I don't think they can. I mean, the reality is, if you look at the history of policy tightening cycles in the United States, they almost all end in accident. Now, those accidents don't have to be 2008. I mean, 1984 with Continental Illinois or 1990 with the savings and loans crisis didn't become 2008. So I think investors could breathe a little bit of caution there. But it is disconcerting that, with inflation at 6%, that, the Fed's caught a little bit between a rock and a hard place here. But to my point on this is, and I said it already, 12 months ago, the Fed funds rate was what, 25 basis points? By the end of next week, it's going to be what, 5%? I mean, that's an awful lot of tightening, leading to a deep inversion of the yield curve, which is creating some of these problems that exist on bank balance sheets. And I would view it as, look, if you don't want to go into an environment of banking challenges, which is at some point going to be inherently deflationary on the economy, I would recommend stepping back from the tightening cycle.
12 months and a couple of days ago, they were still at zero. They've done a ton, Jack, in 12 months. There are some people who believe this is just the beginning. I caught up with your colleague, Bob Michael, earlier in the week. He said, tip of the iceberg. Jack, how do you see this flowing through asset classes now from here?
I mean, when it comes down to the positioning in asset classes, I do think the story is still all about what Fed implications are. And at the end of the day, John, to me, financial stability is more important than inflation. And the Fed's going to have an awfully hard time transmitting monetary policy through a banking system that it's broken. And so I do think that we're probably going to see some sort of reprieve next week when it comes to that hiking cycle. I do think we're also going to get some signals that the end is pretty darn near if next week isn't in and of itself the end of this hiking cycle. Net, I think that's pretty decent for longer-term growthier risk assets that are going to be able to look through perhaps the next few months of volatility, perhaps even a recession, and see a terminal rate that is lower than expected and getting there a little bit faster than expected.
We're going to continue this conversation around the open and bow, but Brian, I just wanted to tee up what we'll talk about around the open, and it's this comment from Neil Dutta of Renaissance Macro yesterday when he said, look, the Atlanta Fed now GDP nowcast has basically got a 3 handle. Inflation's still 5-6%. We're looking at really high nominal GDP growth. There's a reason for the Fed to back away. Is that bullish? Now, Brian, is it?
It's bullish over the intermediate term period. I mean, we still need to see inflation follow through. So you're going to have some volatility until we start to see inflation get reasonably better. But the leading indicators of inflation suggest that we are going to see it come down. And far too often we're talking about being data dependent. Why not look ahead to what is most likely? The money supply growth has collapsed. Businesses have rebuilt inventory. Surveys in the apartment rental space suggest that market is loose as it's been since early days of COVID. So we're sitting here grappling with lagged data, GDP, last month's inflation, rather than looking ahead. And if we're right and inflation does continue to get better relative to expectations, that's when markets start looking ahead to recovery.
Let's keep building on this. Brian Levitt, Jack Manley sticking with us going into the open, 7 minutes away. Equity futures trying to stage a recovery, still lower by about 0.5%. Coming up on this program, the morning calls and later, 2 banks, 2 lifelines, and another day of double-digit declines. First Republic, Credit Suisse, feeling the heat.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate while Cup.
This is a 3. As the economic picture does. The OK is getting ready to make.
5 minutes away from the opening bell, equity futures trying to stage a recovery here. The Nasdaq positive again. It's been that way the whole of the week so far. Equity futures on the S&P down about 0.4%. That's the price action. Here's some morning calls for you. Wells Fargo upgrading Warner Brothers to overweight, highlighting undervalued streaming service relative to its peers. Cowen raising its price target for FedEx, $235, expecting 3Q results to keep it well positioned for a better second half. And finally, Wedbush downgrading First Republic to neutral, a $5 price target, citing valuation pressure in a takeout scenario. Coming up, turmoil in the banks, keeping Wall Street divided on the Fed's next move. That conversation continues with Brian Levitt and JP Morgan's Jack Manley.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
NASDAQ every single day this week. Monday, Tuesday, Wednesday, Thursday, positive on the NASDAQ. 4-day winning streak, and on the week so far, the NASDAQ 100 up around about 6%. Can we add to those gains? On the S&P 500 futures, trying to stage a recovery here, going into the cash open, we're down about 1/3 of 1%. That's the opening bow. Switch at the board and get to the bond market. Yields look like this on a 10-year, down 10 basis points. Your yield right now, 347.34 at the front end of the curve. I've said it all week. The 2-year trading like a penny stock. The 2-year right now in America on the Treasury yield curve, we are down by about 9 basis points to 4.06%. Elsewhere in the FX market, Lagarde went 50. Powell will go who knows where. Euro dollar 106.29, we're positive 0.2 of 1%. And crude has had a really tough week this week. South to 70, 67.87 on WTI. We're down about 0.7 of 1%. We are about 30 seconds into the session. Your equity market looks a little something like this. We are negative 0.2 of 1% on the S&P and just about lower on the NASDAQ too. On the NASDAQ composite, down about 0.1 of 1%. One stock to watch at the open, it's First Republic. A $30 billion deposit injection from the biggest banks on Wall Street failing to lift sentiment. Shares back down by 16 or 17%. Shonali Vasek, this has been a tough week for this bank.
It certainly has, and it regards the end game of this bank as well. On one good hand that you're seeing here, John, is the flight to deposits from the big banks over to First Republic helps shore up the confidence a little bit here. But there's still questions about whether this gets sold at the end and what that means for shareholders and bondholders. Remember, I think the bond action here is really interesting, falling below 60 cents on the dollar, back above, under pressure now as well as the equity. Remember, these bondholders are hoping for a sale at the end of the day. You also just have to watch how clients are moving also. I wanted to take a look at Schwab here as well. Sometimes it's a question about viability at the end of the day. Sometimes it's just a question about profitability. You have massive flows here from prime money market funds to government securities here. So that risk appetite of clients as well makes a big difference for a lot of these firms beyond that deposit flight.
Shonali, you've brought up a really good point. It's about the profit challenge now, not just for that bank, but perhaps the whole sector and maybe the line between the regionals and the big ones here on Wall Street.
Yeah, I mean, I've never had more intensity, John, around an earnings season, because another big question here is where their deposits are going, how much they're fleeing the smaller ones, and what it means for the big ones. I think we won't get a full answer to that. I was in a bank this week, asked for a number on deposits. He said, I can't tell you because they're coming in so fast and hard. That means they've got to be taken out of somewhere else.
Shonali, I think we know a few of those names, don't we? Thank you. First Republic right now, down about 16%. The broader banking sector following suit, a string of bank failures dragging the KBW bank index down 20% in 1 week, casting a shadow over the entire industry. The turmoil continuing to spread through lenders big and small. Abby has more. Hey, Abby.
Hey, John. Well, it really is incredible, and I would argue that it's exactly what you've been talking about this morning, a crisis in confidence. Yes, yesterday that backstop for First Republic tied it up a little bit with those stocks rallying yesterday, but the fact that you have these stocks down big time again today suggests that investors don't think that it's over, that some of these banks could in fact go the way of Silicon Valley Bank, or to Shonali's point that you were just talking about, the profit outlook. So you do have that KRE down once again. Big declines, down about 30% over the last 15 days, down 12 of those 15 days. And you can see that PacWest, Western Alliance, really doing the same thing. Now, we, of course, have the big banks backstopping the smaller banks, and those big banks such as JP Morgan, Citi, Bank of America last year forced to take these mark-to-market losses through regulatory capital. So they're down less. You can see the dramatic divergence over the last year. And it's not all bad, John. We do have the KRE, again, down sharply from its recent highs. That means some investors are trying to bottom fish. If we go into the Bloomberg terminal, we will see the inflows on the KRE. Well, I was looking all the way back to the banking crisis, or I should say the GFC, the financial crisis. These are record inflows right now, John, for the KRE.
Abby, thank you. What's a market check without Credit Suisse in the mix? That stock down by 8.6%, 185. Lower the session, 176, a break of 80. Again, a little bit earlier. A fresh dose of liquidity failing to put concerns over the bank's fate to bed. The stock heading for its worst weekly drop in 3 years. Ollie Crook has been staying close for us through the hour. Over in Zurich. Ollie, thanks for being with us, mate. Let's go through it. UBS does not want to dance, does it?
That's right, Jonathan. And really, the question is, it's the same question as yesterday, is how much runway does 50 billion francs buy you? And we turn to the market to try to answer that question. We see the shares down up to 11% today. You really don't want to see that if you're in the building behind me, 36 hours after that huge liquidity injection. And this invariably asks the question of what is the future of this bank? That invariably brings up this question of the tie-up with UBS and Credit Suisse. And invariably, it brings up all of the other issues that brings up, antitrust issues, the client base, and all these other reasons that, that it may or may not make sense, and in many ways it does not make sense. They do not want this. But here the question is for me, John, after the 3 days that Credit Suisse has just had, how much of that business is UBS going to get for free?
That's a big question, and it's a similar question to what we've been asking here on Wall Street for some of the big players with deposit outflows migrating towards them. Ollie, thank you, mate, for that. Credit Suisse lower over in Swiss trading right now. Credit Suisse is down by 9%. First Republic is down by close to 21%. Jack, I want to come to you on this. Ollie, our colleague there, just went through everything that's happened this week with Credit Suisse. They've tapped the S&P for liquidity, 50 billion Swiss. We've seen 11 banks in America come together, deposit 30 billion at one institution here, and yet here we are staring at prices lower, aggressively so. Jack, what does it take right now to instill confidence?
John, I mean, that's a really hard question to answer because so much has already been done. This feels like, to me, almost like a landslide here in terms of sentiment. People just not wanting to be the last ones out. I do think it is important to draw a distinction here. Are you worried about the shareholders or are you worried about the depositors? And when you're looking at these institutions, whether they're here in the United States or overseas, the quality of these banks still seems to be reasonably high enough that depositors probably don't have a whole lot to worry about, especially when you consider what the Swiss National Bank has done, what Lagarde said in her press conference yesterday, what the Federal Reserve did alongside the FDIC and Treasury over the weekend. But shareholders, I think, are in for a bumpy ride, at least for a little while longer, as the sentiment kind of gets sorted out around here and we find a bottom.
Brian, you say you are tactically defensive. What is that? And is defensive only in the NASDAQ at the moment?
Yeah, I mean, we started to see market sentiment deteriorate towards the end of February, and by that I mean you see credit spreads moving up a bit. The dollar got a bit stronger, so it was clear that the market was getting beyond its soft landing hopes and starting to think about below trend and weakening growth again. And so for us, that's a tactical shift to be more defensive. And when you're more defensive, certainly an increase of an exposure to fixed income away from credit towards higher quality bonds, but also moving up in size and shifting more away from value and cyclicals to growth and defensive. And so, it's been interesting what's been going on in the NASDAQ. Certainly the NASDAQ stocks, many of which were hated last year, are being viewed as more of a defensive position here. And they're getting the benefit of lower interest rates, which we've seen across the yield curve. And, this idea that prior to a few weeks ago, we were going to be persistently in a higher nominal growth environment, I think investors are coming around to the fact that we're going to return to a low growth environment. And in a low growth environment, investors tend to look for those businesses that can grow and sustain in that environment, and many of those are in the NASDAQ.
NASDAQ 100 up for a fifth straight session marginally this morning by 1/10%. Jack, is the NASDAQ defensive? It sounds absurd because a month ago it also sounded ridiculous and the NASDAQ was still outperforming. So is it defensive?
What a weird world that we live in, John, where bad news is good news for so many market indicators right now. I mean, I would say you could play this defensively because at the end of the day, the NASDAQ is growth and it's technology, and tech is ultra sensitive to interest rates. And if you want to have a silver lining approach to all the chaos, all the mess of the last 10 days or so, it's that the terminal Fed funds rate this year is likely going to be lower than we would have expected post Powell's commentary last week. That net is good news for technology. But, John, the caveat here is that it's not growth at any price, because I don't think rates are going back down to zero anytime soon. So I would agree with Brian's sentiment earlier that quality is key, not only in the bond market, but also in stocks.
Jack, do we have to pretend that inflation doesn't exist anymore for this trade to work?
I don't think so, John, because, you know, if we're talking about lagging indicators, and I know that was sort of a theme of an earlier conversation, looking at that CPI basket, the shelter component, which is the biggest part of CPI, is a real lagging indicator. It just does not reflect reality right now. And if you look at what's going on with rental prices, they are starting to level off. We're seeing outright rental deflation in certain key markets like New York City. That's going to feed through very quickly into inflation. We already saw a 0.4 of a point drop from February relative to January. I think if we are patient just a little while longer, these numbers are going to get a lot better, a lot faster.
So, Brian, two issues. We talked about the NASDAQ and the outperformance in tech so far this week off the back of these monster moves in the bond market and the reduction of pricing out of Fed hikes, the pricing in of Fed cuts. Got all that. The other issue, Brian, that's come up repeatedly through this week are the guests that come on this program and talk about high-quality fixed income, investment-grade debt. And the question I keep asking, Brian, what is that? And can we get a little bit more specific? Because last week, I can pick out some financial institutions that were also IG and now face existential risks.
Yeah, and you see it on the corporate side as well. I mean, when the banks are tightening lending standards, you're seeing corporate borrowing costs going up and spreads widening. So that's how these things typically play out. So you want to be a little cautious there. Obviously, you would favor investment-grade corporate bonds over higher yielding in this part of the cycle if you want to be more defensive. Now, with regards to treasuries and regards to mortgages, yeah, there's some banks that have been caught offside, didn't hedge their interest rate risk, or just did not believe that the Fed was going to be as tight as they ultimately were. But for investors in their portfolios, John, not that long ago, they were saying the 60-40 is dead. They were running out of the bond market, and what you find in periods of turmoil is that rates melt. And so investors looking at their statements at the end of this month are going to see that the bond component, the government bond, the high quality bond component of their portfolio held in quite nicely, did perform very well during a period of volatility in the equity markets.
Brian, I just want to finish on this, looking at First Republic. It was halted after dropping pretty aggressively by 21%. It's resumed trading and it's down by more than that level now. Where are we? Down 22%. I've got the low of the week as 1750. We're at 2650 right now, call it 2660. And as we've talked about already, Brian, this is developing even after 11 financial institutions in this country got together, banded together and put together 30 billion US to deposit in this institution, and yet still we face this as they suspend the dividend and face seemingly a real profit challenge as well. Brian, are we facing another one of those weekends where you're looking for a rabbit out of the hat before Asian trading starts, before we come back in Monday morning?
Well, it's possible. I mean, the one thing we see is that policymakers do stand ready to provide support if necessary, not necessarily to to save everyone, not necessarily to save the equity holders, not necessarily to prevent the bondholders from getting less on these things, but the reality is the policymakers stand ready to provide to maintain a functioning banking system. I think what investors have to realize is in a zero rate world, we had gotten very used to all financial institutions being able to maintain it. It's not as if historically we don't get into these challenges. Tightening cycles tend to end with shocks and crises. Most importantly for investors, though, and Jack had mentioned this earlier, this is not, we're not sitting on with banks with piles of worthless assets and we're waiting over the weekend to see, how we're going to stem a contagion to the most globally integrated banks in the world. This is challenges that are very specific and nuanced to certain entities that were offsides for a much higher interest rate environment. So, yeah, we may continue to look to see for signs from policymakers that they're going to provide support, but I would caution investors about extrapolating that to mean that this is going to be the next global financial crisis.
Hey, Brian, thanks for that. Brian Levitt there, Jack Manley. More constructive view at the end. More constructive view of developments so far. 13 minutes in, equities down 0.4% on the S&P. Coming up, Treasury Secretary Janet Yellen in the hot seat.
What is your plan to keep large depositors from moving their funds out of community banks into the big banks?
That's certainly not something that we're encouraging.
That conversation up next with AMH down in DC and Allsprings, Margaret Patel. got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Every community bank, regardless of the size of the deposit, will they get the same treatment that SVB just got?
A bank only gets that treatment if the failure to protect uninsured depositors would create systemic risk.
Lawmakers grilling Secretary Janet Yellen over the government's response to SVB's collapse. Yellen defending the efforts, saying fears of contagion prompted federal regulators to act. For more, let's get to Anne-Marie down in D.C. AMH, what more can they do?
Well, that's a great question, Jonathan, and what a moment for the Treasury Secretary to be speaking to lawmakers under fire when you have this concerns in America about regional banks and, of course, the Atlantic issues with Credit Suisse. Her point yesterday was that for the regulators, number one priority right now is financial stability. But that moment there she had talking to lawmakers when she said that FDIC had to step in, concerns about contagion. That is the next question everyone has. Is this a precedent now that if there is contagion, the FDIC will be this backstop? That is a massive concern when it comes to these regional banks. And then, of course, today, if you look at what's happening with First Republic, questions is, was this enough? These big banks coming to the rescue of First Republic, of course, orchestrated by Janet Yellen and her colleagues herself.
First Republic right now down about 16 or 17%, trying to stage a recovery. AMH in Washington, Anne-Marie, great reporting, particularly on that meeting with Jamie Dimon and Janet Yellen just yesterday. That was from Anne-Marie here at Bloomberg. Margaret Patel of Allspring, looking for a silver lining if it's out there. Here's the quote. The potential good news for the economy is that the Fed may stop raising rates and even consider the possibility of cutting in the near future. Margie, I'm pleased to say, joins us right now. Margie, wonderful to wrap up the week with you on this program. Let's start with this question. Have they done enough?
Well, they've certainly done more than enough damage to the financial system. They raised rates
more than they have in history of any cycle, 4.5 percentage points in a year. And after we had a period from 08 really through the COVID crisis of 21, the 2-year short rates are below 1%. So what do they think would happen to the financial system with this huge adjustment in short rates? The rest of the economy looks pretty good. Consumers, business, leverage doesn't look good. There's no sector that's out of line, particularly compared to 08, the financial crisis. So this is a crisis of the Fed's making. If they would admit their mistake, what I think they should do is cut rates by 50 basis points and say, we made a mistake. We need to unwind the liquidity crisis in the financial system.
Mark, as you know, there's probably a lot of daylight between what you think they should do and what they will do next week. We're still debating whether they'll hike. This market's been all over the place. I know your remit leans you towards the equity market a little bit more now, Margie, but the bond market, you've seen this bond market develop for decades. Have you ever seen it trade like this, the way it has done over the last week?
Well, no, and no one has, because we've never had a financial crisis when the economy is in pretty good shape, and we haven't had corporates be over-levered, consumers be over-levered. That's what's so remarkable. We've had a run on the financial sector. They should bring back the uptick rule, and perhaps that might control these huge outflows that we've seen of speculative activity in the banks.
How's your equity market call changed over the last week?
Well, I've always felt since the Fed began raising that the risk to the market was the Fed itself, what the Fed would do. And once again, they delivered on that. And they now have a situation that's pretty unsavory as far as financials are losing relative strength. People are panicked, taking money out of the bank, really making the crisis worse. But underlying that, other sectors of the economy look good. Technology, industrials, materials, healthcare, and consumers all look very healthy. So if the Fed would stop damaging the economy, I think the economy could begin to stabilize. And I think we're in for a period of modest growth. Inflation on its own was already rolling over. So we just need the Fed to stand back.
And Mark, even if the Fed stands back, this is what people anticipate now. And I'll use the words of Michael Hartnett over at Bank of America. This is what people anticipate at the moment. Bank emergency borrowing will lead to tighter lending conditions, will lead to small businesses facing a credit crunch and higher unemployment. What's the argument, Margie, against that?
Well, the argument is if the Fed eased up, temporarily stepped back, lowered rates, you would see this financial indigestion in banks really, I think, subside. And you have to say to yourself, if you try to hurt the economy by raising unemployment, causing real damage to the financial system, what are you really accomplishing in this?
Margie Patel there of Allspring, thank you. Equities doing okay, I guess. First Republic down about 16%. That is not great. Up next, your trading diary.
think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
It is going to be a long session for some of these banks. The Russell heavily weighted to the financials, struggling again, down a little more than 1%. The Nasdaq up for 5 straight sessions every single day this week, and the S&P down by 0.4%. That's the price action. Here's the trading diary. Coming up, the UMich Consumer Sentiment Survey, top of the hour. Looking to next week, US existing home sales out on Tuesday. ECB President Christine Lagarde delivers some remarks again too on Wednesday in the main event. Fed rate decision, Chairman Powell news conference, then the Bank of England follows on Thursday. From New York City, that does it for me. Good luck for the rest of the trading day, and if you can, enjoy the weekend. This was the countdown to the open. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010, after staying for almost 1 year in a hospital. He died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Benegold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Benegold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes, Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone. just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
the GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. A language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, we say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well, and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money?